Welcome, everybody, to another episode of Smokin Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we have the pleasure of speaking to Som Seif, founder and chief executive officer of Purpose Investments. Before I steal any of his thunder, I'm going to turn the tables over to Som and let him do a bit of an introduction of Purpose Investments, as well as a bit of his background and how it all came to be. And then we're going to chat about some unique products that Purpose has in their shelf and how they fit into investors' portfolios. So, Som, thank you very much for being here and joining us today on Smokin Bulls, and I'll turn it over to you.
Great, Tyler and Dave, great to see you, and thanks for having me on. And happy to kind of start off with a little bit about the background of Purpose and what we're doing. Purpose is a large asset management firm that I founded about 10 years ago. I've been innovating in financial services for some time now. I founded a firm prior to Purpose called Claymore that was really a leader in driving the kind of Canadian marketplace into exchange traded funds, and really focusing on how do you innovate within passive investing and fundamental driven investing. That business was bought by BlackRock and is a part of the iShares portfolio now. And then I founded Purpose really with the focus of how do we continue to innovate within financial services and asset management, not just focusing on how do you bring, call it really high quality investments with call it low costs and transparency and all the rest of it, but rather also how can you also add a focus on meeting outcomes for customers. So, driving innovation in the way that not just, you're focused on investing in the benchmarks and beating the benchmarks, but rather how do we actually align with a customer's goals around the kinds of incomes and the target returns and the risk-adjusted returns that they're looking to do, and how do we do that with precision to help advisors and investors build more resilient portfolios. And so we've been building that. We run over $20 billion today in Canada for a broad set of Canadians, from small investors all the way to multi-billion dollar families. And we're really excited about continuing to lead innovation in this country. And we've done a lot of really important things from cash management, in innovation in cash management, traditional investing, how to build a better dividend portfolio, how to build, really strong income streams with a low risk, all the way to unique strategies like crypto, and really leading this country and the world in getting access to cryptocurrencies like Bitcoin and Ethereum, which we think are very unique and interesting, but most importantly, a safe and secure way to do so.
That's awesome. I like the idea of you're innovating products that fit into a client's need versus clients just trying to figure out what fits their need. Maybe as a way to get started on our first topic of conversation today, Som, we wanted to talk about one of those cool products on your shelf. It's not really a product, it's more of an innovation around how you work with people with large gains inside of their stock portfolios. You guys, I think, refer to it as your in-kind exchange program. Maybe you can touch on that and how it works, and even we'll get into maybe some examples if we have time as to how people have used it to their benefit.
Yeah, it's a really important product, not one that we talk about broadly to everyone, only because it's, what I'd say, it's not a problem that every Canadian has, but for those who do have it, it's a big problem. And, I've been focused on this problem for pretty much my entire career. I'll give you some history of that in a minute. But, when I think about this, the specifics for everyone listening is, oftentimes an individual will, out of luck or out of just, positioning, maybe they were an executive in an organization, or they invested for a long period of time in a company, and it just, over many, many years has compounded nice returns. They find themselves in a situation where a single stock or a single exposure in their portfolio represents a large part of their wealth, maybe an undiversified position, but more importantly, also has a very low cost basis, meaning they bought it at a very low cost, and it's appreciated such that it has a very a big capital gain in the event that they were to sell it. And oftentimes, as taxable investors, the right decision might be to diversify, to sell that down and to, reallocate it across a more diversified portfolio, or to, take a risk off the table on that single position. But because of the tax challenge, people sort of, hold on and try to avoid that. But they're taking on more and more single security risk in their portfolios. So, it's a problem. And as I said, like, not every Canadian has it, but when they do, it can be a big problem. It's not just a problem for wealthy people. It's a problem for lots of people. Any percentage of your portfolio in this situation. So, when we see this, one of the things that Purpose, I've been focused on was how do we help people in that situation, focus on the risk management component of it. So we designed the in-kind fund about 10 years ago, and I'm really proud of what we did there. As you say, it's not a fund per se. It's actually a structural strategy that allows someone to manage this risk. And basically what it's designed to do is to help someone, in that position to take the stock that they own and diversify it while not triggering the tax or deferring the tax situation. And it really helps them avoid that single stock risk or concentration in their portfolio, and take off that tax situation from the portfolio mind or the decision. It's been a very powerful thing, and we're really excited. I mean, lots of great stories of things we've done over the years, and we've helped Canadians with this problem when they have $50,000 of single stock exposure, all the way to many hundreds of millions of dollars of single stock exposure, and it's been something I have some of my best stories, I love helping people solve problems in this business. This is one where I get the most thank yous afterwards, and where you really help someone change their life in a meaningful way. So it's really powerful.
Well, they probably needed that back during the Bre-X scandal. How many Canadians held on to a large amount of Bre-X and wouldn't sell because they didn't want to pay the tax?
Well, actually, I'll give you a real life example that I went through, which is Nortel. And actually, a lot of Canadians felt this one. So, and this is what actually triggered me originally to this problem. If you go back, remember in 2000, Nortel was a part of Bell Canada, and Bell Canada decided to spin out the Nortel to all of the Bell Canada shareholders, if you recall, right? And this was just at the peak in January of 2000, at the peak of the price of Nortel, when the price was the biggest stock in Canada. I think it represented like 30% of the stock index.
Yeah.
It had a $200-300 billion market cap. And all these long-term traditional dividend investors were going to get butterflied out the Nortel stock into their hands. And most of them had BCE stock, Bell Canada stock for like 40, 50 years, 60 years, and probably had a zero cost basis on that stock. And so I was at RBC at the time in investment banking, and we created a company an investment vehicle called 59 Corp. And actually, for anyone who's curious, you can go on to CDAR, which is the government website that where you file prospectuses, and you can find the preliminary prospectus for this. It's called 59 Corp. And what it was, and by the way, anyone who held Nortel and watched it go down, I'd encourage you to go look at this, because it goes to show you that sometimes we do drive innovation in this business that is really positive for people, and they just don't pay attention. Anyways, what happened was we launched this, and what it allowed for people to do was to take Nortel stock and to roll it in on a tax deferred basis into the S&P TSX 60 ex Nortel. So the 59 other companies in the S&P TSX 60, which would have been, if you remember at that point, RBC when it was, trading at like $10. It had energy stocks when oil was at $10 a barrel, and income trusts were just about to become a part of things. And so the ex-Nortel part of the index was depressed and value oriented, and the Nortel part was very high. And if you actually plot that trade of taking Nortel and buying the 59 other companies, you would have done phenomenally well for the next 7 to 8 years. Was a phenomenal trade. Unfortunately, no one did it. And so we went out and we marketed this for 30 days. It only was a 30-day window. It was right at the time when the Nortel stock was split out. And no one did it because what happened was at the time, the price of Nortel dipped down by $10, I think from $110 to $100 a share, because all the non-taxable investors, the pension funds and things like that, actually sold down when they got the Nortel stock. And all the retail, of course, didn't. So everyone was like, oh, I love this, but I'll do it when Nortel goes back to 110. And of course, famously, we all know that Nortel stock never went back to 110. In fact, it went bankrupt. And a lot of people lost a lot of money. And so it taught me a lot at that point. I was a young banker. It taught me about the problem. It taught me about the psychology of this problem. It taught me about the challenges of friction and issues. It taught me about the diversification of going from a single stock problem to multi, what's the decision on the stock holdings that you'd go into. And I kind of, set out in my career over the years as I was building other businesses and all the things to always try to solve this problem. And then when I started Purpose, I said, I'm going to tackle this. It's a really interesting historical example, but one where I think we can really help people. And we have a lot of examples today that we've seen too, but we can really help people secure their wealth and their foundations of wealth without taking single stock risk.
That's good. It's interesting. I mean, I remember, another firm that we had worked with back in the day, they were looking at tackling this problem as well, but it just never came to fruition. What was that?
That was Next Gen.
Yeah. Next Gen, when it was, that was 2004 or 5. Yeah. And I think they just kind of worked hard on their corporate class and never really got to, I think they're going to call it X or something like that. I can't remember, but yeah. So, I mean, it's something that we do a lot of planning for our clients. It's not just full on investments and go talk to your accountant type deal. It's like these type of strategies are a niche and unique. If you're good at applying them, this really opens up to, a lot of clients, like you said, who have this problem. And it's really hard to get a client to move on something and pay tax. I mean, it's just, although we did a poll, I'd say about 3-4 years ago, maybe longer. We went to all of our non-registered clients when markets were kind of at a good, getting frothy. And they said, would you prefer we sell your investments off and trigger a gain, or would you prefer that we ride it out type thing? And I think it was like 90% of them said, sell it and trigger the gain and we'll pay the tax, and which was surprising to us. We've always just been working on defer, deduct, delay, do whatever you can. And in reality, clients, if the tool's available, they'll take the tool. If there's no tool available, they'll take the tax. They don't want to take the loss. But
that's the right decision.
Don't do it. Yeah,
it's the right decision. And frankly, look, I mean, paying taxes means you've had a gain. Like that's the really powerful thing. Like we pay taxes because it's actually been a good outcome. The impact of it really comes down to in some cases the net effect of it. So for example, if you let's say you owned a bank stock and you did really well and you had $1 million of bank stock and it pays a 4% dividend and you're generating $40,000 a year and you have a low cost basis on that. For a lot of people, if they were to sell that bank and now have $750,000 net themselves, replicating that $40,000 a year, it means their income stream is going to be impacted. And so that's the real, where we see it most is, and they call it day to day of most individuals is, the replication of income streams, especially for retirees. And of course, if I'm a founder of a company and I have, $20 million of a stock, it's all about like, okay, what's the risk of my foundation and the wealth that I've got if the stock was to go down by 20 or 30 or 50%, and you want to secure some of that. But for the most part, where we see it really impacting people is in income replication, specifically around retirement or when they are relying on their portfolio for income.
Yeah, and if this is something that's been that you say you developed 10 years ago, obviously we're taking stock and we're shifting it into a collection of purpose investments, and then the gain is then triggered in those purpose investments. Have you ever run into any kind of CRA feedback? Has there been any issues tax-wise? Is there any, problems, I guess, from a tax perspective?
No.
This is all
no. 10 years of doing this for many clients, and frankly, it's a very structurally sound model. We use a Section 85 rule, which is what very standard financial planning tool that a lot of individuals use to manage tax, and also to move positions from personal to corporate holdings or from corporate to corporate. And it's the same concept. And what's really important here is there's no tax avoidance. It's actually tax deferral. And so it's diversification. And in fact, if you think about it from a tax perspective, it's actually securing that there will be a tax some point in the future. If you bought a company stock and the stock was to decline by 90% or 80%, then now that tax take that the government will take in the future has actually gone down substantially. So in many ways, it's deferring it and securing that, there will be a tax at some point in the future. So it's actually a good thing. So no, we've never had any challenges or issues from a regulatory or CRA. It's pretty kosher. We work with strong legal and tax advisors to work with us on how to developing it and also managing it. So,
I mean, you said like a corporation run by a family. I mean, they have different classes of shares. They might introduce new classes of share. They're shifting around between classes. I mean, technically, one class has a gain. You can still shift that between other classes because eventually those classes will trigger the gain. You're never dropping the deferred taxation that you have coming. It's just shifting it a bit until it's triggered when the time is right.
Mm-hmm.
That's right. And it brings a tool that effectively, our tool is used by very wealthy families and senior executives and large owners of stock and all the rest of it. But at the same time, it's accessible to the average investor as well. And so that's what makes it really powerful, is that it brings the kind of planning tool that anybody can do at any scale to someone who has a $200,000 portfolio or a $500,000 or $1 million or $5 million or $10 million portfolio in a really simple and low cost way. And so that's something I'm really proud of. And that's, again, you talked at the outset, like we love solving problems at purpose. And when we see a customer problem, we see a market problem, we thrive. I'm an engineer by background, and I love reverse engineering a problem to a solution. And this is what we've done here is we love leading in innovation around problem solving for customers. And I'm very proud of it. So happy to go into some of the technical stuff around it, but the basics of it, are very simple. And that's what also makes it very elegant is it's so easy to use for an investor when they're ready and looking to do something with it.
What does that process look like? I mean, how does a client go about taking shares and somehow moving them to Purpose's ownership and then getting a portfolio in return?
So
touch on a little bit about the mechanics of it.
So what's really important is, Purpose, we have a broad set of portfolio investment funds available for investors to buy any way they want. So advisors use our products with cash and traditionally investing in it. The in-kind fund is really set up, if you think about it, as a way to buy any of our funds using stock instead of cash. So instead of showing up with $100,000 of cash, you can show up with $100,000 of Royal Bank stock. And so what happens is that we have an in-kind fund. That fund is, if someone had, let's say, $100,000 of Royal Bank stock, they would subscribe for the in-kind fund with $100,000 with the stock. So it's whatever the stock number of shares are. So let's say that's 1,000 RBC shares. That's a little bit more than $100,000 today, but 1,000 RBC shares. And so they would subscribe for the fund with that. And then at that point, they'd also say where they want to go. Where do I want to end up in? And so let's say they wanted to go into a diversified portfolio of equities and bonds and real estate, and you could build a portfolio that way. Or you just wanted to go from RBC to a diversified portfolio of dividend stocks. You could go to, let's say, our core dividend fund. But you would select a end state that you want to end in. And so they'd subscribe. That process takes about 5 days from start to finish. So, the day they subscribe, they put in the subscription form. The wherever the stock is held, so in the account that it's in, that's where the subscription form will come in. We will then work with the back office of the organization they work with, and they transfer out the RBC stock and they transfer in the new Purpose funds. And now the investor has $100,000+ of the Purpose fund. They retain the same cost basis. So if you had, let's say, a zero cost basis on those 1,000 shares of RBC, they would now have a zero cost basis on the purpose funds that they selected. And then at that point, they no longer have exposure to RBC, and meaning that RBC could go up by 20% or down by 20%, and it's irrelevant to them. What really matters is now the return of the purpose fund. So if the purpose fund goes up or down, they'll participate in that. And over time, they can now redeem that and sell that anytime they want. They can do all the same things they could have done with that single stock. So they can donate it. They can, call it sell it in pieces. But the beautiful thing is they've now got a diversification. They've got immediately a diversification away from RBC, and they've got they haven't triggered a tax gain today, but they will pay taxes when they sell the purpose fund some point in the future, based on the value of the purpose fund minus the cost basis. The beautiful thing around that is they can do that for 5 years, 10 years, 50 years. They could do that to their estate. And so there's a lot of really nice things around that deferral for them in terms of the length of compounding of their proceeds and returns over long periods of time with that diversification. So it's a really, really neat model. The funds that they buy are very low cost. We charge the same management fee for a investor who comes in via cash, or if they come in via the in-kind. The only difference is we have a in-kind structural fee that we have to pay in the context, which ultimately makes the in-kind fund a little more expensive, but still quite reasonable, in terms of the fee. So we charge about, on average, let's say 50 basis points, and the in-kind funds classes charge about another 50, 60 basis points on top. That's about 1.1%.
Which is minimal considering the tax deferral and savings that you would experience in these situations. Now, I assume now the end investor has lost their connection to RBC in your example, but now I guess Purpose takes ownership of that stock position. You guys must have a great big position of all these stocks now that you've taken over for clients. Maybe we're getting into the weeds a bit here, but what happens if that position craters for you guys? I mean, is that...
Yeah, we've managed that risk out, so it doesn't. We hedge out we're indifferent to if RBC was to go up by 100% or go down by 90%. There's no portfolio risk to that. In fact, actually, what's really great is the investor who's come in with the RBC doesn't, the RBC position doesn't influence they don't own RBC unless they bought a fund that had RBC in it. And it's a normal natural strategy. So, for example, if you went from a RBC to a dividend portfolio, we might own RBC in the portfolio in a small percentage, but that's not because of the in-kind fund. So they're divorced in that sense, and that's a really important point of it.
Kind of one last question on this. Any limitations to who can be in this? What's the dollar amount? Obviously, I assume there's a limitation on a particular stock. You have to approve that first in case it's something that's thinly traded or can't get rid of, that type of thing.
Yeah. So starting point is that minimum is $50,000 for the position, and that's our break-even point. So we pay all the costs on the back end of executing all this stuff. So it's our minimum because that's the break-even point for us to do the trades. And then anything above that. So, as I said, we've done trades from 50,000 all the way up to several $100 million. So $400 or $500 million. In terms of this, the stock, the limitation is that it has to be, one, it has to be a public traded company, so it can't be a private company. Two is it is Canadian or US company, so it can be Apple and it can be RBC or anything like that. But I always say the test on liquidity, it has to be a stock that generally does have liquidity. Now, liquidity tests are simple. It's like, if you can't sell the stock you have, then we can't sell it. We're not a liquidity option for you. So, that's a simple test. But generally what we always say is, anything in the sort of TSX 60 is absolutely easy and eligible. And then after that, it's, you always come in and we always ask the advisor to ask us and we'll give you the details on it. It also depends on the size of the position. So, example, if it's $1 million of RBC, it's very easy and simple. Even if it's $100 million of RBC, it's still easy. It just might take a couple of days to do as opposed to all in once. And I'm using RBC because they're the biggest company in Canada, so they're also one of the most liquid. And so it really depends on the size and the position. We've had individuals who've come with, let's say, $30 or $40 million a small cap or mid cap company, and frankly, that sometimes doesn't work because it's too large of a position relative to the size and scale of the company. So those are the things that matter. We always tell clients that, work with your advisor, ask us in advance. We have a very specific, we respond within hours on, whether something's eligible or not. But pretty much we try to help people as much as we can. So anytime that we think that there's a solution, we'll solve it.
That's great.
Well, it's a cool product. It's one that we're glad that we have in our tool belt to offer to people. And I'm thankful that you're able to share it with us today, Som. So if it's okay, maybe we can switch gears a little bit here and talk about another product that you guys have on the shelf, or this actually is a product that is on everybody's lips, it seems, and it's the cryptocurrency market. Purpose has two products, I believe. Purpose has a Bitcoin ETF as well as an Ethereum ETF. And I think you guys might have been first to market in Canada with those products. So maybe you can share with us a little bit about your outlook in the cryptocurrency world and how it fits in people's portfolios. A lot of people have a lot of hesitancy. We see it in our own client base, people hesitant to see crypto showing up inside of their portfolios. So let's chat a little bit about that. It's a very popular topic right now, and I'm sure it's one that you've got a lot to say about.
Yeah, no, it's something I'm actually quite passionate about, and there's two reasons which I'll put into buckets with. So first off, very proud. We were the first in the world actually to launch Bitcoin and Ether ETFs in the world, and we're really proud of that. And it's a really great innovation not only for Canada to lead on a global scale, but also for us to have the ability to work with regulators to give safe and secure ways for people to access crypto if they wanted to, which was really important to me from the beginning. So look, crypto is a very unique and as you say, a polarizing topic for a lot of people. I have personally been invested in and focused on this space since 2016. Why I've done that is because as an innovator, I'm always looking for what are the things that are unique and interesting that you need to be paying attention to, and building my own theses around those. And so, that's a core component of it. And I'll spend some time on the backstory and my own thesis there. But secondly, and separately, independent of thesis on our side, what's really important to me is we believe that when investors want to have access to something that is unique, it is really important to cut out the noise that can happen in and around those spaces. Those are very noisy spaces. If you think about junior mining companies or areas where sentiment can become very powerful in a market, they also can be places where people can get into a lot of trouble. And so this was one where we felt that there was a lot of noise. And we also felt that there was risks that individuals could lose binary outcomes of returns without maybe have the right call, but have a binary outcome. So we always felt that it was important to help people have safe and secure ways, low agency, low cost ways, and efficient ways to access these areas. And that's what led us, independent of our thesis, to innovate around the ETFs. And actually, in fact, prior to that, we launched a company called Ether Capital when all of the infrastructure wasn't even there for ETFs because of this very same point. And so, we launched the ETFs 3 years ago. We actually have 4 products today. We have a Bitcoin and Ether ETFs, and then we also have a Bitcoin yield strategy and an Ether yield strategy, which are really designed around option writing income, call option writing income on top of Bitcoin in one case and Ether on the other to generate an income stream, really for people who want to have a different type of risk profile to the exposure. And we're really proud of that. We run over 3.2 billion in assets across the space now. We're one of the largest in the world. And the noise that you've seen in the last 60 days around the US launching the first Bitcoin products down there is really gotten great awareness and sentiment around the space. Prices of cryptos have moved up and the demand side of things have increased. But they've really done what we did here in Canada 3 years ago, which is again a testament to what our market has been focused on. So happy to get into some of the specifics. I'm happy to go into the thesis side. But I've really, what I'd say for everyone is this is a space that I encourage people to build their own theses on, to have their own perspective, and that can be I don't want to own them, or I'm going to wait and see, or hey, I want to have this as an exposure in my portfolio for these reasons. But the one thing you don't want to do is just buy them because everyone else is buying them. You don't want to have that FOMO or sentiment kind of perspective. You want to buy it because it actually has a very specific thing that is particular for you, or you don't want to say I don't touch these things because you heard it on some person said I don't buy crypto and so therefore you shouldn't buy crypto, because I think that, in my opinion, is actually the wrong reason to do this. I'd ask you guys, tell me a little bit about what you're curious about in the space and what it is that you're also thinking about nowadays in advising clients.
Yeah, well, I guess a couple of things. I mean, for us, it's always just it's an asset class. What percentage do we delve into our portfolios? We're discretionary managers, so we run 3 portfolios, so it would fall into our alt sleeve, and what percentage of that is the right amount. So that's something we're working on always. And for us, when we have discussion with clients, like you said, there's a lot of things that have happened that discourage people from being part of it. And I always try and accrue it to, it's like the 20s in the stock market. You gave money to a broker, and the broker turned around and lost your money, or your broker borrowed against your money. And then, when they lost it, they lost their money, they lost your money too. And you're like, well, how is this possible? So I think people confuse sometimes what crypto is. They confuse how it's transacted, and they see all of these exchanges basically stealing people's money, and they think, well, this it's a fraud. And of course, this is how people in the black market or in the mob move money around the world. So that's this is what they focus on, and that's why you're going to get people who say I'm out. So having some knowledge, and I think that's part of what we're working on is discussing with our clients to get their knowledge level there a bit. For the most part, clients look in the portfolios, and I'm not sure of what we build, how much they really dig down into the portfolio. But when you're going to use something like this, it is, who was it back in the day? David Chilton, this might possibly be something in the client's portfolio that is something you talk about at cocktail parties, because the rest of what's in the portfolio is not. So I think
that's right.
Exactly. So that's where we're at with it. And, we think it is a legitimate piece. There's lots of reasons. We've done a lot of reading on it. I guess we're looking, in your sense, how much of a client's portfolio, and we're not those 60-40 portfolio. I'd say right now we're probably 50-20 on the fixed and 30 in alternatives. Yeah, is what our mixture would be.
So my perspective is I believe that every investor, maybe not retirees, who are late in retirement income and all the rest of it, but most investors should have 2 to 2.5% of their portfolio in crypto today. And what's really important there is let's take a 45-year-old who's still building wealth and growing. When you think about the upside downside risks of asset categories, if I have 2.5% in crypto, and I'll get into the details of my view on Bitcoin and Ether and other things, but what's really critical is that the risk of that in terms of both on asymmetric upside and also downside is that look, if at the end of the day crypto was to go down, and just to be clear, crypto is not going away. Like all the people who still like to put their head in the sand and believe that Bitcoin should go to zero and worthless, they are lost in their mindset. They're still thinking about 2015, and 2015 it was a time when Bitcoin could have gone away, but it's not anymore. And we've proven that through many different periods of, call it, cyclical environments. And so if Bitcoin goes down by 50%, okay, you might lose 1% in your portfolio total value. That's a risk. But on the other hand, what's going on in this space, and when you get into the deep thesis of how this could ultimately translate, there is an asymmetric return stream potential. And so having a participation that's actually quite unique and important. So I look at that as why I say 2.5% is because the risk of loss, if I lose 50, 60%, is not going to really dent my long-term portfolio. But the participation on the upside as a really interesting thing on an asymmetric way on the if it does actually meet its long-term goals could be quite unique for the value add in your portfolio. And so that's where a purist, let's say the Warren Buffett purist would say, well, it has no intrinsic value, doesn't pay any income, so why would I ever own it? But what they're missing is that there are going to be so many different influential factors. I believe in nonlinear systems, and what we cannot or project out is how the world will change in innovation technologies and products of the future. And so this is a really powerful platform that you want to have some component of your portfolio exposed to. The when I get into what I would say though, when I get into high net worth space, ultra high net worth space, I find that they actually own crypto much greater than the mass affluent would be. So what's been amazing in the last number of years is that where we see the biggest, call it concentration of excitement or energy around this, has been in family offices and ultra high net worth. They might have 5% or 7% of their wealth tied up in crypto. And oftentimes it's because they're looking at their portfolio from a different risks. They're looking at it in the sense of like, what happens if system breaks? What happens if inflation really picks? And they're looking at these things and they're trying to find different ways. They're also, by the way, historically the ones who would use gold more regularly in their portfolios because they're looking at it to hedge out certain components of their wealth in a different way. So it's funny that like when you get into the higher end of wealth, they are actually more interested in things like crypto and alternatives like this because of it's hedging against something that could be quite meaningful to their wealth in a relative basis of the future size. And then, of course, we see younger people, millennials, who will have substantial amount of their wealth oftentimes in crypto. And that's something that, I'm talking about like 10, 20, even up to 50% of their wealth. And then there are, that small group of very strong crypto enthusiasts that will have 80% of their wealth in it. But those aren't for normal people to think about. And in my opinion, even in the millennials, look, I don't doubt and blame anyone, to have that belief, because if you think about the world around you, you want to have something that gives you a deep asymmetric bet. I just would always say that you want to, if you have those wins, you want to start taking money and building foundations from there. And when you've got very little money and the industry doesn't treat you pretty properly, you want to make these kind of outsized bets because you also have time if it doesn't work out for you. So it's interesting when you ask that question. My guess is though, the average mass affluent Canadian should have 2 to 2.5% of their portfolio in crypto, in my opinion, and that's probably a good position for someone to be in.
Well, and I would think that's probably close to the number that we would think as well. And if you take that, it ties to one of our other questions too. I mean, if you even use that number and spread it around the average Canadian's portfolio, let alone the U.S., the fact that they're on stream now with their own ETFs. A lot of the investment advisors have a 90-day moratorium that hasn't even kicked in. So if you were to even talk about 1% of the average discretionary portfolio holding Bitcoin or Ethereum, that's a massive amount of asset money to come into that space.
Yeah, and so let's turn to a little bit of the thesis on it. So my background on this was I was like many people in the space, back in sort of mid 2015, 2014, 2016. When someone would say Bitcoin, I would kind of respond with, it's probably a fraud or something like that. And I would do TV and media and things like that. And they'd ask me and I wouldn't really respond in a positive way. And then I kind of stopped and said, hey, wait a minute, like that's not my style. I generally will only comment on things when I feel like I've got some insights. And so I should be either saying nothing or I should go and do some research and, probably better to go dig in and understand what this thing is. And so I spent about a year, becoming a student of, crypto to understand Bitcoin, understand Ethereum and understand what was going on here. And frankly, it blew my mind. And at first, Bitcoin didn't really energize me. I knew what it was. I knew what it had done. But when I started to learn about Ethereum, it was really powerful to me because it was, my mental model of the future of finance and the way that things were going to evolve. I had a vision for how our business would move forward and how I was innovating within it. but I was falling into a limitation on very specific infrastructure components of it, where I felt that the industry could not solve for. Ethereum was when I understood and really delved into it, it was the first thing that helped me close the loop on my mental model. It was the first time I saw, wow, now I can see the true future of finance and the true innovation that can happen. However, this was 2016, and Ethereum was still like a project. It was an idea. Had some really smart developers and everybody around it, and there was a great community building, but it was so early. And so I looked at it and said, this thing could be a zero, but if it works, the asymmetry on the upside could be powerful. And so I got very excited about that. I invested in the space. And then I said, around that time, 2017 time, you saw the initial coin offerings start to come out, the noise and all that noise. And you heard about in Canada, the Quadrigas of the world, that was a fraud. Of course, last year we had the FTX situation and so on and so forth. But like the point is, they had all these things that started to come out in noisiness. And I said, I want to be a participant in watching this asymmetric bet, but I want people to come along with me on this. So I started a company called Ether Capital Corp, which the whole principle was, let's go buy some Ether and let's really be a participant in a safe and secure way. And at that point, you couldn't build an ETF. You couldn't do all these things. There was no institutional infrastructure. Anyway, so that was 2018 when we did that. And I'm still leading that, and that's been a really important thing. But the big thing for me was, and by the way, like all along the way, I've been a student of the space. I've been really focused. I've been making investments. And why I've been involved is because to me, this is the innovation that will drive the future of our industry and the way we deliver financial services, not just jurisdictionally in Canada, but globally in a really meaningful way. If I step back though, and I look at now, over that time, I've also started to learn and develop a better appreciation for Bitcoin. And what I would say is, when people talk about crypto, you can't say Ether without Bitcoin. Bitcoin was the first. It was the thing that was a linear, amazing. It blew your mind when they first developed the initial principle of what Bitcoin is, which is basically a way for you to transfer value between two parties in a trustless environment without an agent in between it. It is the pretty amazing construct. It is linear in meaning that it has one use case to it, which ultimately leads to currency-like, meaning transfer of value between two parties. But it is actually what's in the dynamics of it that make it so unique, which is that it has a limit in terms of 21 million Bitcoin that can ever be minted, and the infrastructure of energy and structure of how it can never be destroyed. And that is so powerful when you think about currencies and the challenges that we have with the US dollar or currencies globally, is that like you can print a lot of them, you can keep printing them. There's no call it limitation. There's a risk of like fraud. There's all these elements to it. And so in fact, it becomes a very unique, although 21 million of them, very unique, precious asset. Even gold can't say that there will, be a limit to the amount of gold you have. And so it's a very unique asset in that way. And what it leads to though today is that it is a sentiment trade. It is a social experiment in Bitcoin specifically. It is a very different outcome. It is all about this idea of going from the fringe to the center. And what happens over and over again is we've moved from the fringe closer and closer to the center. What happened in the last couple of months in the US, as you put it, with the Bitcoin ETFs launching, just brought it more and more to the center as a core asset class. Now, gold took 3,000 years to do that. Bitcoin is 15 years old. And so we didn't get to watch, the speeded up gold history of becoming a sentimental asset for, and having that, call it core perspective. But Bitcoin, we are watching it in real time. And, we have a hard time watching these things happen in real time. It's the boiling frog syndrome of issue. But for those who can actually step back and have a rational perspective, it is fascinating to watch this social experiment occur. Ethereum, on the other hand, is actually a very unique technology. It will transform, in my opinion, it will transform the way commerce, finance, and assets ultimately transact in a digital world in a powerful way. So very exciting. It is more of a utility. It has high utility in its form, and the principles of the foundations of what Ethereum will ultimately provide, in my opinion, unlimited in terms of what its potential economic value could be. It's pretty unique.
Yeah, I've heard people compare Ethereum or use Ethereum as an example would be to buy a house, and all the different intermediaries that are involved in order to transact on that home could be done using the technology that underlies Ethereum. And that's kind of neat. I think you eliminate all of these third parties and just transact directly with the buyer and seller.
Passing title on a USB stick. Well,
it's a great example because most people, of course, have gone through that when they buy a home, and think about all the agency and what that is, the friction, the costs, the people that do something in between the day you buy a house and the closing of that house. And, whether it's title insurance, whether it's contracts, whether it's legal lawyers, whether it's your, representative agents. And, at the end of the day, you buy a house and, you paid out 6, 7, 8% of the value of that house in costs, right? And all for what? Just to get a title from this person owning the house to you owning the house, right? Mm-hmm. And so, to your point, Ethereum is an infrastructure utility that basically allows for smart contracting, so you can do anything. But the reason why the current system works is because there's two parties that are going to transact in a very high dollar value in a trustless environment, meaning that I don't know you, you don't know me. And I need to know that when I hand you the keys, you're going to hand me this, and all of it's going to play out properly. And so with Ethereum, you can do the exact same set of things, all the stuff that is required, and do that pretty much for 12 cents.
Yeah. When we're explaining this to our clients, I think one of the things that we've at least come to, and sometimes, you get pigeonholed, that we really don't want to talk about anything other than those two. There's a lot of noise and a lot of fraud, a lot of just creation of something that we don't see it fitting a use. I mean, in essence, Bitcoin is somewhat of a digital gold. It's a store of value, and the value and the worth of that is based on a whole contingency of people around the world who see it as having value. And that's just how, people, when the markets are bad, they would run to US treasuries and they would run to gold. This is fitting in that kind of niche. This is not a transactional type. Like you said, you can pass money between two people, but this isn't going to be something that's going to be used. You're not going to have a Bitcoin credit card. You'll be at the till for 10 minutes or whatever before everything goes through. So Ethereum to us is more utilitarian, like you said, where almost any transaction you can think of that's not, sending a large value of money between two people. I mean, I'm sure it could be used for that, but from a point of view of making transactions work in a different way without all the intermediaries, Ethereum seems to be more utilitarian and has a purpose that way. I'm sure there's other crypto that's trying to emulate that or do it differently, do it better. I think from an investment and a portfolio management point of view, we wouldn't even look down that road. And I think a lot of those that are in the background are what confuse the everyday client to even Bitcoin and Ethereum. They don't even want to talk about it because of the complications with the other 300 different coins that are available out there.
So there's three things that when you're building these networks, these platforms, that people are optimizing for. First is governance, 2 is security, and 3 is scalability, right? So, if you want to do high volume, you need scalability. If you want to do it in a way that's trusted, you need a proper security, and then you need governance. What is the governance model so that you can't go and change it, right? And so the problem with Ethereum many years ago was that they had gotten governance and security right. So meaning that it was secure and they had a really phenomenally democratic governance model around it so that you knew that no one actor could basically change the game, right? The problem was it had to solve for scalability. And so what does that mean is that like when you wanted to do 1,000 transactions or 1,000,000 transactions or 1 billion transactions or 1 trillion transactions on it, what was the cost to do those transactions? And so what's happened is that over the years, they've had all these players coming out, Solana and Tron and all these other things that have come out, and they call themselves the Ethereum killers Because what they've done is they've said, we're going to trade off one of security or governance to fix the scaling concept. So Solana is a great example of that, which is, we will, like, when we can handle 1 trillion transactions and do that on a per unit transaction of like 0.001 cent per transaction, which is kind of like what the Visa network or some of the big transactional networks would look like in the traditional finance world. But what they're doing is they're doing that by giving up on governance or on security. So, if you were doing a low value transaction, something that was like, hey, I'm going to transact with you and do something that, send $1 to you, it's probably better to do that, let's say, on the Solana network. But if I was doing a high value transaction, per se, buying a house, that's one, but that's a big one. But it could be something like, hey, I bought a nice asset and I want to secure it, and I want to know that it's secure. Let's say that asset's worth $1,000. You would not want to do that on a low security like Solana. You would do that on Ethereum. So you'd be willing to pay the 12 cents for that transaction because it's a higher value transaction. So what's happened is that as Ethereum has been building, all these other platforms have come out and tried to solve, but they're dropping something else to do so. All along the way, Ethereum keeps focusing on solving the scalability problem. And over the last number of years, if you've been observing and watching, they have really made amazing trends. And in a couple of weeks, they're doing a new upgrade to the system called the Decoding upgrade, which will actually increase scalability to be like some of the other platforms, such that it will cost like a penny per trade or per transaction to secure the transaction. So Ethereum has been getting it right. They're the sort of if between the turtle and the hare, they're the turtle that is doing it right. And all these other networks are trying to kind of win by going after something, but they're giving up something really powerful, which is security and governance to do so. And so why I've always been so excited and why I've always been never said that Ethereum, anything's ever kind of gotten in my face and said, hey, something's better. And in fact, I said this in 2021, that I said, guys, Ethereum has already won. Just few people know it. Like me, people haven't really accepted that yet. But Ethereum won in 2021. And we're seeing the benefit today. And so my view is Ethereum will become the core foundational utility backend of the blockchain and the future of commerce and finance and all the rest of it. And there'll be all these micro networks that will now build on top of it, but they will secure on Ethereum in the back. And that's what's, I think, going to be very fascinating to see. So I am a huge believer in Ethereum. I personally have been involved in it for a long time. And I just continue to believe in the asymmetric view of that in the long run. And what's really cool is investors, when you buy an Ether token, you are buying a share of that future platform. That's what has always got me excited, because it's like buying a toll road. You are buying a share of that toll road for however it plays out for the future, right? And so that's why I've always believed in the asset.
Very cool. I think we're bumping up against our time allotted today, Som. So to be cognizant of that, we'd like to thank you for sharing your comments with us today. It was enlightening to learn about the stuff that Purpose is doing, and we thank you for taking the time with us. And if our viewers want to learn more about us or about the products we've talked about today, you can head over to smokinbulls.com. You can also go to towerwealth.com, and you can follow us on our socials. So thank you again, Som, for being here, and we look forward to connecting with you again in the future.
Great to see you guys, and thanks for having me anytime.
Right on. Thank you.